Hi, this is Bruce, the accounting guy here again today, and today I bring you LIFO inventory evaluation. We're continuing down that chapter for inventory. Remember we said we were going to do FIFO, first in, first out, LIFO, last in, first out, and then the weighted average. Today we're going to concentrate on LIFO, which is last in, first out. Now, do remember that when we do these are allowable methods under generally accepted accounting principles and don't really actually show the actual flow of the inventory and the way it was sold. If we go back here to this chart and we look at cost of goods available for sale, again, this was right out of your book. We used this for the first in, first out one that you've already looked at, and we're going to use this for weighted average. Remember again, we had our beginning inventory units of 100. Here's our purchases of 200, 300, and 400 in this particular order. And then down here, okay, we also knew that we did what? That we had sold 550 units. And so what we have to do is evaluate our last 450 units under first in, first out. Now under first in, first out, LIFO, I apologize, last in, first out. Under last in, first out, called LIFO, we're saying that the last units sold, last units in, are the first units sold because it's last in, first out. Now in real life, we physically know that it would be impossible for these units of 400 to have been, because they were purchased in November, to really have been sold before this January 1st lot of 100. Again, this is nothing more than a cost flow assumption. So what we'll be looking at is if we have sold 550 units and we only have 450 left, as we've done in our earlier example, which 450 of these would be remaining? And because of the fact that we say that it is, again, last in, first out, the last units in would be the first units sold, and we would have actually sold these units first. Again, it's physically impossible, but it's a cost flow assumption. So these units would have been sold first, and these would have been the units that therefore would go into our cost of goods sold. And we would, and again, our ending inventory, which is what we're calculating, would be our beginning units of 450. So we'd start from this layer. We'd say we had 100 units at $10 per unit. There's the ending inventory calculation here, January 1st, 100 at $10, and it's extrapolated out to 1,000. And now we still need another 350 units, so we go to the next level or layer of 200 units. And we can use all of them because we still need 350, so 200 of these at 11, and that would come down to the April 15th purchase of 200 at 11, cost us $2,200. At this point, we've used 300 units. Now, since we've used 300 units, we still have another 150 that we need to put into our inventory because we wanted 450. So we'll go to the next layer, which was the August 24th purchase of 300, and we'll take out the last 150, which is at $12 per unit, and as you can see, that's down here. Once we do that, we add these up. We do have 450 units, and our total cost is $5,000. Now again, this is our ending inventory. This is the number that would show on our balance sheet as ending inventory. Notice what we haven't done is we haven't used what we've sold. What we sold were the 400 units at 13 and 150 of these at 12. Now we don't have to extend that out because we know, again, from the calculation that we've already learned, that total goods available for sale, which was the $12,000, excuse me, dollars, the $12,000, from it we subtract our ending inventory. If this is everything we had to sell and we still have calculated 5,000 left, we would take the 5 and subtract it from the goods available for sale, and we'd come up with our cost of goods sold. Note that this cost of goods sold is higher if we jump back over to here to our cost of goods sold under FIFO of 6,200. Now again, as I said before, this is really nothing more than massaging the numbers to the type of method we want to use, FIFO or LIFO. Notice that under LIFO, we're getting our last units in. Actually, we're saying these are the ones we're selling. And in times of rising prices, as we can see, the units went up throughout the year. If we're saying that the last units in are the units we've actually sold, we're getting our higher cost out into our cost of goods sold. Now, that means that if we have more in our cost of goods sold, we're going to have lower income. Now, that may make the company not look like it's earning as much, but in reality, companies would rather keep a lower income so they can make their income taxes lower and pay less in taxes. External users will look at the financial statements and see which method's being used, first in, first out, or last in, first out, and they know how these dollars can really be massaged. I hate to use the word income manipulation, but that's really what it is. We're manipulating the numbers in right when we know our dollar amounts are going up for the cost of our inventory. If we use last in, first out, we know our last units in are what we're going to expense out, and therefore we're taking our most expensive cost and we're putting them into our cost of goods sold to purposely lower our income and have the company pay less in taxes. Where in this case, when we used our first in, first out, we actually kept more of the cost in our inventory and less in our cost of goods sold, and therefore our income became out higher. The real cash flow is exactly the same for both of these companies, but all they're doing is massaging, manipulating the numbers, again, to make their income lower so they'll pay less in taxes. And a lot of companies like using this method that have rising costs because they know that they get their greatest cost out the door into cost of goods sold and therefore can lower their income and pay less in taxes. Right now this is allowable by the Internal Revenue Service. Not just generally accepted accounting principles. Another argument in using this method is we're putting more relevant cost into our cost of goods sold against our sales when we use LIFO, because we're taking the last units in, making them part of our cost of goods sold, and that's the real cost. Okay, that's the real cost of the most current cost of the goods currently. These were beginning of the year costs, but now we have ending of the year cost, and those costs are going to again be more relevant, and therefore we put them into our ending inventory and therefore are able to get a more relevant cost in there against our cost of goods sold. Now, another thing that I do want to let you know about is what's called IFRS. IFRS is the International Financial Reporting Standards. Up till this point in time in our accounting procedures here in the United States, we have not used them. What we've done instead is just follow generally accepted accounting principles. But currently, between 2010 and 2014, it is planned that the United States will move in more in line and follow international financial reporting standards, and more general education is being given not just to college professors but to the practicing CPAs and companies out there so they can start implementing this. One thing under IFRS that will not be allowable is last in, first out. All the other countries, majority of the other countries in the world don't use this, and the reason is they do know that it's very, very manipulative. So that's something that may not be used in the very near future. The other thing is the Internal Revenue Service is going to phase out LIFO and not allow anyone to use it either. So those are a couple other things to keep in mind. That's all I have for you today, and I will see you again real soon. Bye for now.